Hi, everyone. For those who just logged on, my name is Dominique, and I have the rest of the Greenleaf team here with us today. Today, we will be conducting our end of quarter reviews for our residential portfolio. But first and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week, highlighting a portion of our business. Private events being more interactive, while live streams are open to the public. So before we dive in, we want to provide some rules of engagement. First, you do have the option to change your presentation view. Feel free to switch your attendee presentation mode to speaker spotlight, or you can click and drag to make the presentation of our panelists bigger or smaller. There will be a Q&A portion at the very end of this presentation, but you do not need to wait until the end to submit any questions you may have. You can click the Q&A button located at the bottom of your screen to submit your questions, and our team will be sure to answer those. This is a friendly reminder that this live stream is recorded and will be shared via email by the end of the week. We have on the screen here some topics of discussion and today's agenda. First, our panelists will provide a market overview. We'll dive into both the the apartment segment, as well as mobile homes. And then we will close with future residential plans. And then again, we will break out into that Q&A session at the end. All right, without further ado, I will pass it over to our hosts, Dave Kodre and Josh Friedenson.
All right, thank you very much, Dominique, and thank you everyone for joining us today. We are excited about how the quarter went. We think things went pretty darn well. We have some couple points we're going to talk on, which I'm sure people are curious as what's happening or what we're seeing in the market right now. Two of those things are the eviction moratorium and kind of what we're seeing with supply and demand. And those, in our view, those two things are very tied to one another. So if we think about the eviction moratorium, we scheduled this live stream for, well, we had some slides, and then Tuesday those went out the window. So,
well, I mean, Saturday was really the big event day of the eviction moratorium.
Yeah, Saturday was, and then Tuesday was the opposite.
Yeah, exactly.
But we scheduled this for early part of August here, mainly because the eviction moratorium was supposed to end July 31st. So that was a big time. I mean, we've been dealing with kind of the kind of like opening and closing of that door since March of 2020, which at this point, yeah, it's been a long time. So just kind of recap from the end of Q2, the Supreme Court had ruled in June that the eviction moratorium was going to is going to expire July 31st. It was Kavanaugh on the Supreme Court that was the basis that unless Congress comes together and makes some kind of decision, the CDC cannot extend the moratorium, so it's going to end July 31st. We were gearing up for that, and by gearing up for that, I mean just kind of communicating effectively throughout the organization and preparing for the workload that's going to come with that when that does eventually hit. I'm sure everyone saw headlines and stuff that Tuesday the Biden administration enacted. We're still not fully sure what it means, but it's essentially an eviction moratorium for areas that have high rates of COVID. So in short, it might be like, hey, if there's an area that has a whole lot of COVID cases, you can't evict those people, but if they don't have COVID, you can. I'm not sure it's conveying the right thing, but politically, why it doesn't really matter, right? So they're extending for another 2 months. But even if the federal one expired July 31st, as we were preparing for, there are many other layers of this whole thing that are not just the federal component. States, counties, cities, they can all also do whatever they choose in these regulations. And DeKalb County, Georgia, even before July 31st, they had said they're extending through September. That's just one county. We operate in like 50. So trying to now figure out what are all of the county by county regulations is slightly challenging. We aren't going to put a big chart up to tell you what all of them are, but our compliance team is working diligently on that as we go through and work through the evictions we do have. So the eviction moratorium in general, we're going to touch base on what that means kind of for supply and demand, but overall federal numbers that are coming out are showing about 14% of renters are behind. It's roughly 10 million people that are in some state of they're behind on their rent and not making payments. And on the housing side, like the homeownership side, it's about 3.5% of people are in forbearance. That's not just that they didn't pay their mortgage. That's like they're actually in a forbearance program. It's roughly 2 million people. So that's 12 million total people that are behind on some form of housing payment. So we've got some slides that we're going to walk through that kind of talk about what that does to a supply and demand standpoint here. So you can put the non-payment options up here. So typically, like someone moves out, or this is most of us when you're kind of like in college, you're looking for roommates, or you're out of college and you're like, wait a minute, I gotta pay my own bills now. You're like, I'll get 25 roommates if I can get them. So you kind of have these options. If you're not going to make a rental payment, or you don't have the money to rent something, you normally either move in with your parents, find some roommates. Josh and I've had lots of roommates. I slept on Josh's couch for a little bit when we first started this company. So you're like, hey, maybe find a roommate's a good thing. Or you get a new apartment. If one place is too expensive, you move and get one that's cheaper. So for the most part, all of those result in a new housing unit becoming available. And then we added this other option in here, right? The stay and don't pay.
Yeah, so this has been introduced with this eviction moratorium, where there's an alternative option where basically there's an occupied housing unit without payment being required, which is, we're going to go into this, but it's basically artificially inflating the occupancy levels in the apartment business and the housing business as overall.
Yeah. So if we looked at these, like you're enacting artificial supply constraints. You can jump to the next slide. Right. So here you've got essentially not all 10. If you're staying and you're not paying, then not all 10 million apartments will become available that normally would be available in the market. So that supply is actually constrained, while the demand in the area of the country that we're in, we're seeing positive population growth. If you're on last quarter's live stream, we talked about the positive population growth happening in all the southeastern states. So that's increasing demand, but you have this constraint on supply that's artificial. The demand is real though. So we're seeing pretty severe rental rate increases for that. So essentially the people that are willing to pay and are moving are paying to cover the ones that are not. So, but there also is this other aspect of it too, the recover and pay. We've talked about this throughout this, kind of the pandemic, that there are people that are using the program of, hey, you don't have to pay rent because there's no evictions, to actually get caught up. So I don't want it to sound like, hey, nobody's paying and no one's doing anything. It's really just a few bad apples in the whole pool that are doing that. Like, hey, I have a job, but I'm still just not going to pay because I don't have to. We had a resident just 2 days ago that paid out from, they owed about $12,000 to $13,000 in back rent, and they took a loan, or they closed out some of their investment dollars, and they were able to pay us. So that typically would have resulted in an eviction, and instead that person was able to stay long term, and they ended up actually paying us. That's a positive thing. So there is that recover and pay option. But in general, the longer this eviction moratorium goes on, the longer it's going to artificially constrain supply.
Yes.
So now we're going to jump in to see, like, how did that impact our apartments, and what did that do?
Yeah. So overall, we have 289 late payers, and when we say late payers, you see this chart. We really shouldn't be looking at the two green categories. These are people that would normally be a little bit late, like the 197 batch. The biggest part about this, these are all balances under 1 month's rent, maybe $50, maybe $100, maybe $200-300. But these people would not be evicted. These people would fell a little bit behind, and they normally caught up. The batch of 50, the lighter green, is kind of where your red flags start going up, because they're about 1 month behind. We would generally start filing paperwork on them, but normally speaking, in a normal environment, 98% of these people pay out and they go right back to their normal course.
Even in this environment right now, though, the majority of them are paying.
Yes.
Because the blue and the red.
Exactly.
The blue and the red are the ones we're concerned about. And those are people that owe 5, 10. Our highest right now is $20,000 that people haven't paid. So when when Josh and I had this conversation 2 months ago on our live stream, we had 35 people that fell into that $5 or $10,000 or more that were owed. And now we're down to 19.
Right.
So
And
it's positive.
19 of our roughly 2,000 housing units and apartments, overall, we're pretty grateful that number is so low. And, overall, in generally speaking, it's not really having a major impact on the business or really our operations. Obviously, we'd love to get rid of them and move on to,
New friends.
paying people, but, we can manage through this.
Yeah, and so those 19 people owe $175,000 in back rent, whereas the remainder, that whole other chunk owes $180,000. So that top little chunk is really, it's kind of the screaming and yelling from like, hey, we need to get rid of this eviction moratorium is really for like 20 people in our portfolio, which is 1% of the population that's having this issue, and a lot of that, they kind of have jobs too, and they could probably pay something. They're choosing to pay nothing. So if we look at our outstanding rent, and we go across this, we're seeing some properties had gains, 13 of them increase in delinquency, but with these higher delinquency amounts, like they're not gonna, like the top 19 have no intention of paying, and they're kind of scattered across all properties. So every property is kind of bound to increase in that environment. So mobile homes, we're going to talk about mobile homes compared to how the apartments did. In the mobile home segment, we actually kind of saw the opposite. Looking at this one, our delinquency is down to $119,000 from $137,000. And we did sell some of our,
Lower performing properties. We sold the Ringgold portfolio in North Point up by Chattanooga. Those had higher delinquency balances on average compared to these. So that definitely had an impact on it. But we're somewhat happy to see that our mobile homes that we're holding right now that are mostly in the Gainesville, Northeast Georgia area are fairly steady, and these numbers aren't increasing across them. There's only 10 people that fall in this category.
Right? Yeah, you look at all of our properties. I can't even talk right. All of our properties had a decline in this kind of outstanding delinquency balance. And L026 is 4 assets that's there in Gainesville. So all of them had a decline, and then Anchor and Creekside were kind of stable on the delinquency amounts. So with the assets we do have, they're going in the right direction on this front. But similar to apartments, you see these top 10 people, 4 people over, the 4 and the 6 here, they owe $46,000. That's the bulk of it. And when we talk about evictions, it's not that we haven't filed evictions. All of these people that are in that kind of like that deep into the non-payment, we filed evictions on them back in whenever they became 1 or 2 months behind. And now it's kind of in this queue. So whenever the gate opens and there is an approval, it starts from that bottom, whoever was first, and they'll go out. So we're in the queue waiting for kind of the writ component of the eviction. That's the second phase that's really on hold. The filing of the eviction is not on hold. You can file, they just won't be executed upon. So now we're going to jump into occupancy, and we'll go kind of as our portfolio and then deal by deal of what we're seeing. Again, we're very conscious that there is this artificial supply constraint. And we just went through, we're seeing that. We have 19 definitive artificially constrained units, and then some other ones above that as well. So, but overall, we're at 96% occupancy on the apartment side. Everything is over 90%, which is fantastic. We saw some pretty big revenue gains just this quarter, up 6%. We're up almost 20% year over year. You see the far right side here, we got 3 deals, which are Oak Hollow, The Grove, and Heritage. The bottom of this chart is 70%, so it's not like it's 0%. The bottom is 70%, and all of those deals now are up to 90%. And then we also have a few here that, with that supply constraint, we're seeing great revenue gains. So this is kind of like a benefit of that supply is that it's really driving prices. And anytime we have turnover, we're able to capture significantly higher rental rates than we would normally ask for. Josh and I have always been a proponent of longer-term residents, stability in operations, and retention. Our number 1 company metric is retention. We want to have 70% retention. We think that makes for better property. But the people that are leaving now, we're seeing, like Amberwood, for example, we're getting we're getting almost 20% rental bumps.
Yeah, so the people that we renew, we want to incentivize them to stay. So our increase is usually 3 to 5%, fairly nominal. And, part of what Dave was saying, the stability of the property, but also helps stability of our operating expenses. A standard turnover is going to cost us $2,000 to $4,000 depending on, the specific unit. So yes, we love seeing these tremendous gains on turnover, but we have to somewhat moderate them. And to be able to afford.
Yeah, we can't do them all at once.
Exactly. So we're happy to invite them at, as long as they're coming in moderation. And we can we're still going to target the 70% retention, and we want to target fairly nominal increases to keep our people in place.
Right. So even like Saddle Creek, 12% rental bump here. And now some of these properties that we look at, we do have retention that is low. And in that low retention, we look at deals like Silverstone or City View or Fairway, where we had less than 50% retention and people that went to month to month. Now, month to month means they didn't sign a new lease. Technically, we had $100. We add $100 for month to month leases. So there's a little bit of a revenue bump there. But all of these are opportunities where we're going to see higher turnover costs from these people actually moving out, but then also pretty significant rental gains. Obviously not this quarter, they're just moving out, but next quarter, as we lease those, we're going to see this 10, 15, 20% gains in rental rates really across all assets that we're operating in.
Yeah, the City View number 44, we bought that property, the average rent per unit was right about $450, $500 a unit. We did some renovations, turned some units, and upon lease up, we were able to get $750. And now we're seeing revenues coming closer to that $850 range on turnover. So we're somewhat happy to invite, a moderated pace of turnover as long as we can maintain our base.
Right. Yep. So we dive into mobile homes against kind of how the apartment shift looked here. And we had one we kind of sold or underperforming, as we mentioned. So that left us with higher performing mobile homes, and our occupancies at 90% across that portfolio here. We had two assets that had a decline in occupancy, and these ones are actually a chunk of those, like you talk about the long-term non-payers that are some leaving. We had Barnes, we only have 16 units, so it's a smaller property, but we had a resident there that owed almost 2 years, and she's not there anymore. So that is good. We've been working on that for a long time. And then Creekside, we're actually under contract to sell.
We'll probably sell in October.
October.
Yeah, we are working on an easement with the neighbors, so it's been slow, but should be sold in
October. Okay. So, and the rest of the mobile homes we have there, you see a little bit of up and down, but not a whole lot of movement in their occupancy. It's more stable. So. All right, so we're gonna go through our reserves as well, and a lot of the occupancy, turnover cost, OpEx, that all ties into how we do our reserves. And this is kind of it's a good conversation, but we've been trying to tie our reserve strategy to how the business operates. So it's not, property A is not equal to property B, and they don't necessarily have exactly the same dollar amounts of reserves, but they have the same strategy. And what I mean by that is we're basing our reserves on how much we spend operationally. So if a deal spends more operationally, it needs to have higher reserves. If a deal spends less operationally, it can have lower reserves. So we look at this 3 months of operating expenses. And what we're doing is taking the current quarter. If we spent $50,000 on operating expenses this quarter, that means we need to leave that segment of our reserve calculation needs to be $50,000. As that fluctuates in the year, we'll see our reserve numbers go up and down. We spoke about things like Silverstone, where we had a lot of move-outs. We know we're going to have higher operating expenses there. But we should plan for that with our reserve strategy so that we have those funds to go do the turnover. That's why one quarter, it might say, hey, we're at 100%, and next quarter we're below. And it's like, well, what the heck happened there? It's like, well, if operating expenses go up, our reserve number goes up. So we may have the same dollars in reserve, but our target got higher because our operating costs went up. So similar things can happen because we have taxes and insurance. We are constantly negotiating our tax rates throughout the year on property taxes, appealing, trying to get the best value we can on those. So they go up, they go down, and that adjusts our reserve target. The only one that's actually static is this $300 per unit. And we reserve that, and that's pretty set for the most part. I guess unless like Park Hill, where we had a fire, we lost 8 units, so that one went down a little bit there.
But overall in the quarter, revenue's up 6%, expenses were up by 8%, but we were able to basically, that's an overall positive for the business.
Yeah, net was up 13%, $90,000 positive more across all the assets.
Yes.
We got some deals here that we're pointing out that you see yellow because they're recent lease up deals, and that's more on the far right. We have Oak Hollow, the Grove, and Heritage. Heritage, that very far right one, we just got to 95% this quarter, so we're just really starting our reserve strategy on that deal. And then these other 3, we've got 3. They actually have their full reserve. Park Hill looks like it's like 98%. It's almost full. But we actually spent dollars here in Q2 because we're putting down deposits for refinances, and those are all CBRE.
No, Capital One and CBRE.
Capital, yeah, the large one. So we're using the Freddie Small Balance Loan Program for all of our deals, locking in long-term rates as best we can.
Yes.
With the current status of the 10-year, and then if it's over 7 million,
6 or 7 million. Yeah.
It has to go to what we jokingly call Big Fanny,
Yeah.
and that we use those with Capital One.
Yes.
So we're in the works on those. So if we're looking left to right here, anything that was fully green means any of the cash above that was paid out on these deals. If there was something below that, that's where we get into like, hey, we're reserving for something, or we don't have our full reserve, and we need that before we feel comfortable distributing. Deals like number 17, which is Hillcrest. Right now, we're working on some drainage issues at that property in the front of it, and therefore our reserves are lower than what we need them to be. So we're trying to be very conscious of this, especially in this environment. We feel very confident where we are with the pandemic and COVID and even the eviction moratorium, but we're still banking on the side of conservative and making sure we focus on our reserves before we distribute. So, we'll look at this from the mobile home standpoint, and this one looks a little bit like a slide, but you've got our fully funded deals on the left, and the newer deals like the Anchor and the Creekside, in Creekside, which we're exiting, are not fully funded.
Exiting as well.
Yeah, okay, Anchor, we're exiting Anchor as well too. But overall here, revenues were flat on the mobile home side, and our expenses were actually down by 5%. So free cash flow is up by 16% across the portfolio here. We have the same strategy here, but also this is kind of what we were expecting.
Yeah, when we went to mobile homes, our goal there was to really, was focusing on the stability of the tenant, that they wouldn't be turning over as often, and we wouldn't necessarily be looking for giant rental increases on them, but we just wanted more flatline income and lowering expenses over time. And that's really exactly what we're seeing here. Now that we've owned these assets for, going on 3, 4, 5 years now. So 2 of these assets, we actually have Fannie refinance that we have 10-year fixed money on. So that's pretty exciting as well, that we're able to execute that full business plan. And as other ones, you kind of reach that level that we can go to Fannie Mae, we'll get refinancing again.
Yep. All right, so that's kind of the recap of occupancy, what our delinquency look like, how our reserves are, and we want to go into a conversation here on values. So the eviction delays that we're seeing in the market here, those are really driving this rental rate. And it's creating this odd environment with constrained supply that's really driving revenue. We have big revenue gains, properties are worth more, everything's going up.
And overall in our markets, we're not these non-payers are relatively a small percentage of the market. So it's not having an impact on values. It's not really having an economic impact on
it's
the
having
property.
a positive. It's having a positive economic because it's driving the rental rates up so much. And it's also giving, maybe we'll talk about it a little bit, but we're not actually, we don't think that lasts forever, right? At some point in time, that artificial supply constraint will be removed. So but it's not like we're sitting here and saying, hey, this quarter we're gonna have 20% rental bumps, and every year going forward, the new normal is 20% rental bumps. We're not gonna bank on that. Some other people might though. That'd be great for our exits. That works very well on Ridgewood. So, and then cap rates are still historically low. The 10-year treasury, so much of the multifamily business is based on the 10-year treasury rate. Like the biggest driver in multifamily is the 10-year treasury.
Yes.
As that falls and keeps going down and down even more, it just enables lower cap rates and enables people to pay more. And we're seeing revenue growth. So now we've got two things feeding into values being higher. And even this last point here where we see costs are rising. Lumber was like, it's been in the news, like everyone's obsessed with the lumber price. It's because it tells the narrative of maybe what people want to hear is that all prices are going up. And lumber prices definitely went up. They went up a lot, but that's not the only material that goes into building something. It's a big one, but it's not the only one. But that cost going up, it causes multiple things to also happen. So material cost means the value, the replacement cost is now higher. That means the tax basis value is now higher. It means your insurance is now higher. So all those cost drivers create a higher value and a higher expense for an owner, which they then also look to push through on rental rates. So now we've got really three factors that are all driving value and rental rate, all happening at the same time, all with some constraints that we don't believe are permanent. The eviction moratorium is not permanent. That could be a viewpoint, right? We don't believe it's permanent, and we don't believe the supply constraints that we're seeing right now are permanent. Shipping and everything is delayed, but I don't believe that's permanent. Natural markets will work themselves out and improve. So right now we're seeing a huge amount of opportunity in the market from a value creation standpoint.
And Dave and I are constantly reviewing our assets and basically how the income is trending, how the expenses are trending, and really how the values are trending as well. And right now we're in this period of basically pretty insane income growth, pretty insane value growth that we don't really have a lot of anxiety or pressure to really want to sell during this period of time, because we'd be leaving money on the table, because every quarter over quarter right now in this window of time, we're seeing tremendous rental increases. So we're keeping a close eye on it, but we don't really feel a lot of pressure to move on anything unless we see that slow down.
Yep. So opportunity wise, this whole goal of refinance and lock the rate.
Yes.
That's been an ongoing theme. So that really hasn't changed much for us. We love the idea of let's lock the rates, get as low interest rate as we can, and even still have solid debt coverage. We're doing that at 3 deals right now: Park Hill, Rosecroft, and Westside Townhomes. We have all 3 of those deals out. It's not the world where we can just refinance those tomorrow. If we could go be like, oh, the 10-year is great, let's take it right now. It doesn't work that way. We're probably a month.
Yeah,
month, 2 months.
We're probably a month into them, and we probably have another 45 to 60 days. In terms of pricing, on the 10-year treasury, there is usually about a 220 basis point spread on it. The 10 years right about 1.2. So we would see rates right around 3.4, maybe on the high end around 3.7, depending on specifically what happens when we get the commitment letter. So what happens in terms of a refi, we send the package out to Fannie and Freddie via Capital One or CBRE. They take about 2 weeks to basically underwrite it, present an application. That basically is the trigger that we basically start spending money on appraisals and engineering reports to basically do the refinance. That takes about 60 days. Then we get a commitment letter, and then you usually close about a week to 2 weeks after that. When we get that commitment letter, that's really when we have the true terms of what the deal is. That's when we lock rate, et cetera. And that's basically when we'll be able to basically report out to you guys and say, hey, this is our rate, this is the terms, and this is how much cash out we were able to achieve. On all 3 of these deals, we're expecting a tremendous amount of cash out, way beyond our basis. So we're very excited about the opportunity on these 3 specific deals, and we'll keep an eye out on our other assets as the loan. There's a kind of a combination of kind of the perfect P&L to do your refinance, and also the perfect maturity of the current debt that's on the property, because all of our deals have prepayment penalties. So you have to kind of look for the window to prepay them so that your closing costs are not through the roof.
Yeah. So that's our current deals and value that we're very excited about, but it does not provide us with a lot of opportunity to buy stuff.
Right.
So we tried, we were excited about the Blue Sky East Lake Crossing deal, and many of you know that fell apart in the kind of the past month or so here. We thought we had one, and even with everything we did, we still
couldn't pull it.
couldn't get it across the finish line, and ultimately the seller decided that they're just going to keep it and they're going to go do something else with the deal and redevelop it. And we're paying a good amount of money there. We had a huge budget for renovation work. We were excited about the deal, but even with that, not being able to get that one over the finish line, the value or the price that we're going to have to pay to do something, it's just more than we're comfortable with right now.
Yeah,
So
it's more than we're comfortable, also more than the trajectory that we see the market at. The values of today, you're kind of paying for multiple years of the future earnings and future growth projections ahead of you. And we just don't believe in the continued pace of the current environment. 6% quarter-over-quarter income growth. We don't think it's sustainable for multiples of years. So
yeah, we could be wrong, but we're printing lots of money. But yeah, so that's kind of our hesitancy right now on trying to buy anything new in it. But we are very much optimistic on kind of harvesting gains and realizing equity that's in our current portfolio, and then operating well, driving the efficiency we have in there. So we're doing not only well on the revenue growth, but the free cash flow growth too.
Yeah, which kind of tees up kind of what we see going forward, and we talked a lot about this in our commercial presentation. But we've recently sold Ridgewood L28. Really, the income growth there would really slow down. We didn't see a lot of the future potential for that property, so we ended up selling it. It was about a 4.5 times equity multiple, which was phenomenal. It was a huge home run for all of us involved, and we took that money, 1031 exchanged it into 2 office assets. And we're able to basically realize, number one, significantly higher returns on our capital deployed, but also significantly higher future potential with not only the occupancy gains that were already on the table for these office assets, but also the future growth of the office business in these markets. So as we kind of look forward in kind of our upcoming opportunities, that's a lot of what we have on the table. Between our retail properties that, the Zaxby's, we're working with an existing operator that this basically would be the 3rd asset that we're working with them on. And he's shown fantastic performance of operations. We're able to buy this, work with him at a great value for buying a Zaxby's. So lots more details to come there. We have 2 government deals coming up. One in Huntsville, Alabama, which is a insanely high growth market with very high wage earners. So we're excited about buying office properties in a market that is so attractive like that. We have a government lease to the IRS and Department of Defense coming up in the next couple of weeks. And then when we're always looking at these medical office properties that are incredibly well located on hospital campuses, below occupancy, that really the owner doesn't want to afford taking the property to the next level. We can come in, bring some fresh capital, and bring the occupancy up and be in basically a much lower basis compared to already occupied buildings. So we have a great pipeline. We're excited about what's to come, and multifamily is still very much on our radar. We're very much in tune with the market. We wish there were better value propositions on the table, but we're going to apply the same business plan to these other assets and keep going.
Yep. And all the new deals that are coming up, we will have live streams on them to explain what the value is that we see and how we plan to execute them. So look out for those as they're coming up. I'm going to turn over to Dominique now. She's going to kind of go run through our schedule, and then we'll definitely do some Q&A to go through questions that we have in our current portfolio.
Thanks so much, Dave and Josh. Again, this concludes our regularly scheduled program. But before we move into that Q&A, we did want to leave you with some upcoming dates. Again, feel free to use the Q&A feature located at the bottom of your screen to submit any questions you may have, and we will work through those. First, we closed out our second quarter and shared with you our quarterly newsletter and end of quarter reports July 28th, and any applicable distributions should have settled in your account July 30th. We do, as they mentioned, we do have a busy third quarter ahead of us, and we're very excited for all the new opportunities for you. We have our upcoming live stream schedule here on the right. Don't worry, the email that consists and has the video link will include all the registration details for our upcoming live streams. So feel free to register as soon as you have those available. But August 19th, we actually have 2 live streams. We have the Zaxby's live stream where our panelists will discuss the ins and outs of the deal. And then we have the Greenleaf investment strategy presentation where our panelists will discuss what Greenleaf looks for in a deal and what we intend to buy in the future. So we invite everybody to attend that live stream. August 26th and September 16th, we have 2 government office deal presentations for you. On the 26th, we'll discuss 2300 Lake Park. That is the deal that Josh mentioned. It's located in Marietta, Georgia. And then we have the state of Alabama located in Huntsville, Alabama, of course. Well, thank you so much for tuning in. We're going to dive into our Q&A portion. Again, feel free to use that Q&A chat feature. And I will pass it over to Natalie King, and we'll start answering your questions.
Great. Thank you, Dominique. And thank you to everyone who submitted questions. We'll dive right in. First, Dave, you reviewed this earlier, but can you remind us how many actual non-paying residents we're carrying? And are these residents mainly at a specific property or in a specific area?
So we have 19 that are what we call the non-payers on the apartment side and 10 on the mobile home side. So on the apartment side, 2 quarters ago, we had 34. So we're down to 19 now, which is great. Fairway, which is on the west side of Atlanta, has the most. I think they have 3. But other than that, it's pretty much a spread across all assets where we have 1 person there or 2 people there for the most part. Silverstone, I believe Silverstone has 2 as well. So it's not like 1 or 2 people at a property. It's not like, hey, one property has 19 people that aren't paying. So it's very spread out.
Okay. With the eviction moratorium extension, has or will Greenleaf take advantage of the federal COVID funds, which are set aside for rental relief?
It's a good question. We would love to, certainly. It's definitely a tricky landscape of how those were provided to states for the most part and then distributed from there. For the most part, to qualify for COVID rental relief funds, you had to be a resident, you had to be able to show COVID hardship, you had to have an adjusted median income that was below the average for the area you were in. So you had a lot of these thresholds that kind of put you at a, yeah, there's a subsidies available. Most of our residents don't qualify for that. They had a job, they earn more than that, so they were not eligible for that money. And the only state that we were able to actually do anything with was the state of South Carolina. The state of South Carolina made it a little bit easier to work with a resident and apply. There's no programs that we can apply for as a landlord. We can only help a tenant apply for a program. Every single one that's come out, we have gone out and told our residents about and tried to see if they qualify and if we can apply. We've had success with that in South Carolina with maybe a dozen cases or so, but that's it. I don't know if they're going to find an effective way to distribute or manage that COVID relief funds that are out there.
Okay. Are other agencies discussing mitigation strategies for the eviction moratorium burn off?
We talked about it kind of on the local front, right? That there's, you have the church groups and the kind of the for-profit companies that are helping out.
Yeah, they're going to come and help out. Yeah,
right, they're helping out, but on kind of a government agency level, I'm assuming that's what the question was based on. It seems like this is all being kind of delegated to the states, the counties, and
yeah, I
the
mean,
localized
the federal government kind of gave funds to the states, and they're like, here, you go figure something out with it. And they're like, what do you want us to do? So there might be, we've always partnered well with local community churches and local community organizations that are kind of, we're either mixing helping people with rental payments or housing or school supplies or clothes or food or any of those kind of things. There's those organizations are are very much in existence and helping people. They can't really help with the, hey, I owe $20,000 in back rent. So they're there for more like the, hey, I had a bump in the road and I need some support and I need some community, some community participation. That's what they are made for. They're not long-term subsidy programs. So I think if there's short-term bumps in the road, those are there and they'll help. The long-term one, the funds that were provided to the states, I haven't really heard of anything where they're setting up some kind of state agency that's going to provide long-term benefits like that.
You mentioned the eviction moratorium is artificially constraining supply. Do you expect rents to drop when this is lifted? And also, what controls have you put in place to ensure we don't rent to others who were just evicted by other landlords?
Right, so kind of a three-part question. So yes, when the first part is when the eviction moratorium is lifted and cities and counties and states then actually proceed with evictions, that it will add supply to the market. It will force that the current non-paying section, because either can't or don't want to, right? Either one of those, to go find new housing. So yes, so that should open supply or increase the supply. I believe there will be a decline, that drives rents down. But there's still rent growth in the fact that there's a lot of inflation and money supply pumped into the market right now. So if money supply was stagnant, then sure, if you increase supply, prices will come down. But we're also increasing money supply in that too. That's a whole other factor. So, but we don't believe 20% rental rate growth is sustainable. That's probably not going to happen long term. The other part of the question, so what was the whole question?
Yeah, so what controls have you put in place to ensure we don't rent to others who were just evicted by other landlords?
Right, so we haven't rented to anyone recently that's been evicted. So there's that part of it. But there's going to be a lot going on of like non-discrimination or wiping any kind of, hey, I was in an eviction moratorium. It's going to be hard to find that on people's credit, right? Because right now they're saying like no one should be penalized for that. So I'm not sure what it's going to look like on a credit report yet when we do our screening of new tenants once it's available to be on a credit report. But we have a pretty advanced screening process and we're able to pick and choose a lot of what we see. And one of our biggest things that Josh, when Josh and I were first in this business, we're like, hey, how do we learn how to screen a resident? One of the things we noticed is like, are they paying their cell phone bill and they're paying their cable bill? Like your cell phone bill, I don't know if there's any other bill that's more important, whether that's accurate or not, right? Like, I think there are personally other things that are more important, but if you're not paying your cell phone bill, you're not paying anything else. So we kind of changed our screening to focus on like, hey, are they paying the things that are kind of high demand consumer items that they need? And then like, medical bills and
like student loans and medical bills that can rack up these monster balances that, that they kind of fall much later in the process. We're a little bit more forgiving in those categories.
Yeah. And I know there's a third part to that question.
No, that was it.
Okay.
You got it. Okay. Next question. Are you looking at the possibility of another lockdown and taking any proactive action in regards to that?
Yeah. Do we think there's going to be another lockdown? We talked a little bit on the commercial side too. Like we don't really believe we will see another lockdown in the areas we operate in, just because the political environment was pretty negatively received last time. And I think
it was pretty short.
It was pretty short. So, but proactively managing for that, yes, definitely. We need to make sure that we operate Greenleaf so that our investors receive clear communication on what we're doing. We are being a good fiduciary of the assets we hold, keeping our team members, families, and themselves safe, and doing the same for our residents. So we operated very well through COVID as a team, being like, hey, we're now automatically all dispersed, now coming back together and traveling. We did that pretty fluidly. And if there were to be something where there's some kind of lockdown type situation, we feel confident in going through that again. We communicated well with our tenants. Remember, all of our communication, all of our payments, we've worked for years to do all this, is all online. A lot of landlords got hit kind of in COVID and like, oh, we've been taking checks and cash payments. And it's like, yeah, that's not going to work. you got to be able to pay online. So all of our communication is able to effectively be done both remotely and in person. So we feel pretty confident that if it were a lockdown, we'd be able to execute well.
Great. We now have a few property related questions. On the apartment side, you mentioned expenses are up greater than revenue. What is contributing to the margin compression?
So I think our revenue was up $130,000 and expenses were up 80. The expenses, the total number of expense is a lower number. So our free cash flow is actually up, but the biggest thing driving expenses right now is utilities. That's our number one cost driver. We have wages and salaries, that's always a big number on our P&Ls. That's been pretty across the board organization, pretty flat right now. One quarter over another quarter, we didn't have any kind of crazy spike or anything like that. So the main driver right now is utilities, and then any property that had that less than 50% retention, we see pretty large bumps, even against our plans or anything on material spent. So,
are there any other properties you're considering selling this year?
I guess, are there any other people that would like to make ridiculous offers?
Yeah.
So,
I mean, most of the properties that we've sold, in general, in the last couple of years, we've probably sold 2 or 3 assets a year. And probably one of those was planned, and the rest of them, someone came knocking on our door and said, hey, I'll give you way more than you ever imagined getting. And then we asked for even more than that, and they say yes. And
yeah, that's what happened with Ridgewood. Like, that was not on the block, and then they came to us and it was like, oh, we'll give you 100 a door. It's like, I was like, what if we ask for 115? Then they give 115. It's like, okay,
that's 120.
I'm like trying to find their address so I can drive the keys over there.
Yeah.
But yeah, so when we see those opportunities come, we're definitely, take advantage of them. And I mean, Josh talking to apartment brokers on a daily basis.
Yeah, we get 3 to 5 offers on our assets daily. So there's I kind of have a canned response per asset of kind of this insane number. And if there's even the least bit of interest, it turns into a conversation, and then maybe it turns into a contract, maybe it turns into an inspection period. And then if they get through the inspection period, it's like, oh, they have hard earnest money, they're actually going to close. So now we can talk about actually what's going to happen next.
Yeah.
So we're that's kind of in flux with probably 3 to 5 assets a year at any given point in time. And when it becomes real is when we'll communicate it out. And then but in terms of plans, we're really nothing really on the.
Yeah, we looked through the 3 we're refinancing, and we're like, wow, this is just a better financial decision to refinance these 3 with kind of how they're operating. So that was
so those 3 are off the sale block.
Yeah. Because
at any given point, all the rest of them are on the sale block to a certain degree, and we'll see what happens.
Okay. You guys touched on this question a bit in the presentation, but for our last offering, Blue Sky East Lake Crossing, what's the status of the lawsuit, and what options do the committed investors have at this point in time?
So we basically last week we filed the affidavit, which is basically step 1, basically putting the seller on notice, saying, hey, these are our claims, and if you have any responses to it, now's your time before we file suit. And basically giving the option to open discussion, like basically open formal discussions between lawyers that weren't happy with each other. And then kind of the proceedings from there. In general, this process can take a couple days, a couple weeks, or a couple years. I talked to someone earlier today, they went through the same thing. It took them about 2 years to settle it. In terms of what options do we have, so everyone's money was returned, I believe it was Monday or Tuesday of this week. So there was no investor money at risk for the property at all. It's all been returned. And what we're hoping, in best case scenario, is that we can get the seller to kind of take the situation very seriously and decide that, the better option is to sell it to us instead of whatever their other plans are. And we can get this thing back on track, but we're not very hopeful that that's going to happen.
Yeah.
So time will tell, and we'll see what happens next.
Next question is a QOZ question. Based on the status of various properties in the fund, when do you think investors will see some sort of cash distribution?
yeah, so that on the residential side in QOZ, we have Fairway, the Grove, and Heritage, and those are the kind of the deals that are on that right side of occupancy and on our charts. So the structure of the QOZ is a little bit different in that one, it's a mix of QOZ funds and fresh equity that went together and bought those like a tick format we've done on many deals. The QOZ investors that are in that, since we bought that, we don't have a basis. We can't make any distributions until our tax basis is realized, which won't happen until 2025. So on those deals for QOZ specific investors, that cash will be held and sit at the property, and we'll work to make as much as we can there up until 2025, when we realize basis and we are able to make a distribution specifically to cover tax liabilities due in 2026.
We are up to our last couple of questions. So again, if you have more questions out there, go ahead and get those submitted through the Q&A button at the bottom of your screen. Next question's on Heritage Square. Can you please provide more details on the parking expansion and why the DOT rejected our request for more parking? And how does this affect our plans for the property?
So Heritage Square is 40 apartments and we have 32 parking spots, and it's a courtyard setup where you drive into the deal, all the parking's in the center, and then you drive out the other way. We also have a parcel next to the deal that we were trying to add additional parking to, instead of just drive over the curb and park in the grass. What we believe is DOT was basically like, look, you're not going to have enough rainwater retention if you cover this area. So if we put a parking lot in this extra area, like 80% of it would have been rainwater retention. It would have only been able to add like 4 spots. So that really wasn't worth the bang for the buck of doing that. So now we've got an asset that just doesn't have a 1-to-1 parking ratio. We've had them before, and those deals have worked out. Go back in time, we had 214 Randolph. That one was tight. We had 157 Whiteford. That one was tight. We ended up selling both those deals. We did very well on them, which is fantastic. But we've operated in those environments before, and it's essentially like some units, as we do assigned parking stuff, we'll see lower revenue on different units based on parking. We're still at our pro forma revenue right now, so we're happy with the rents we're getting at Heritage. It's just that going forward, we're going to have to manage what it looks like with less parking.
Yeah, in the same breath, this property we just basically got leased up. We're basically letting the P&L season. In the process of that, we'll be basically looking to refinance it, and also looking to value it by shopping the market, seeing what it's worth, making the decision between refinancing or selling it between really now and the end of the year, and then executing on that, maybe late 4th quarter or early 1st quarter.
Yeah. And something like in that situation, we definitely do one of these live streams and walk through the values and kind of how we're assessing the refinance and value position of what we can do with the deal.
Okay. Well, to our last question, it's a good closing one. Could you give us a recap on how Greenleaf is prepared for what's next in the residential space?
Well, with existing assets, what's next is really capture as much revenue gains as we can while effectively managing turnover. We can't have 100% turnover and go spend a boatload of money on renovations and lease. So we've got to manage that turn efficiently, and then really try and capture as much of the current revenue gains as we can. We see them very much as not going to be available long term, so we need to get those now. So we're working on that part, and then preparing for what's next. We're a fan of the residential market. We would love to be buying more apartments in the space right now. We don't see the opportunity right now or really in the next couple of months, but we still have 2,500 residential units, and we're keeping our finger on the pulse of what's going on. So we'll hopefully find some opportunities in the future. We just don't see them in the short-term future.
Wonderful. Well, we will stay online here for a few more minutes in case anyone has any additional questions, but we want to thank everyone for all your wonderful questions so far. And of course, we want to thank Josh and Dave for sharing these residential updates with us. As we wrap this up, just a friendly reminder of some of our upcoming live stream dates here on your screen on the right. And don't forget to check out our Greenleaf Connect YouTube channel for all our recorded live streams, with this recording being made available by the end of the day tomorrow. This does conclude our end of quarter residential broadcast. We certainly appreciate you joining us today, and we look forward to having you on our upcoming live streams. Again, we'll stay online here for just a few more moments, but if you are dropping off, thanks again and enjoy your day.